Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. Another interesting week, to say the least. I think that's one of the things we'll be able to say for at least the next 4 years. Stuff coming out of Washington. It's kind of funny, actually. I know a lot of people are getting really upset about it, but there's nothing to get upset about. It's a little more lively than normal. But your people are beginning to realize that, there's only so much you can do when you hold the president's office. You have to have a lot of people on board to do whatever it is that you want to do. And that's a good thing. So anyway, what kind of things are happening in financial markets? I think that it's kind of interesting. You're hearing a lot about market making all, new highs. And they're making new highs, but only by less than 0.5%. Every time they go up 0.5%, make a new high, that they start ringing the bell. It's been a new high. And people are thinking that it's made a lot of progress. Well, not so much really. If you look back just over the past year, market peaked in 2015 April. At 2011, it's only up 10% since then, and that's coming up almost 2 years. That's unexciting. 5% every in 2 years, 5% a year. That's below average, by the way. So, and when you take out the top 50 companies from the S&P 500, the return drops fairly significantly. So it's not all stocks either, and that's actually a good thing. What it means is that with GDP growth picking up, and it has picked up, and it actually started right before the election. Now that it's picking up and starting to accelerate, and I think that the current administration is probably going to help that, because I don't think they're going to come out with nearly as much regulation as the last one did, and the pendulum happened to swing both ways. So what would have naturally occurred anyway is probably going to get a little boost. That's a good thing. And we're going to be talking about that at the Thursday, March 16th. This is kind of coming up, March 16th at Corporate College on the east side of Cleveland. We're doing a workshop there, really talking about the Intelligent Investor Updated. Intelligent Investor was a book written in 1949 by Ben Graham. He's considered to be, by many, to be the father of value investing. And I think some of the things that he talked about back then are still, are particularly appropriate for today, because you've got so many people that are investing so much money in a lot of companies who really are not underpriced. They're not undervalued. In fact, a huge component of the S&P 500, which a lot of people refer to as the stock market, or even the Russell 1000, a huge component of those stocks are selling at prices that are probably 15-20% higher than they should be, minimally. So when big major components of a major index are overpriced, what can you expect from that index going forward? I can tell you, not as much as you would expect from an index that might be equal weighted or fundamentally weighted. That's what Ben Graham was all about, was fundamentals. Things like sales, profits, not just the share price went up. In fact, I get a lot of questions on this radio show. What do you think XYZ stock? And all they're looking at is the share price. That's all they're looking at. It's the share price. They know nothing about the company. You got to do better than that. That's what Ben Graham was writing about, decades ago. We're going to update a lot of what he talked about. I'm going to bring it in the future. I'm going to show you a couple of models that I run that are based on what I read in that book. And that book is old. Now, accounting standards have changed quite a bit since those days. But the basics, the fundamentals, are actually pretty similar. But how you look at those has changed. The ability of a company to come in and manipulate their earnings has changed dramatically. Not that it didn't happen then either. It did. But I don't think it would have mattered too much then. Most people didn't have access to the information anyway. But today you have access to information. So how to use that access to the information to improve your performance. That's what we're going to be looking at that workshop. What kinds of things can you do? What kinds of things am I doing to try to improve investment performance over just buying a market cap weighted index like the S&P 500? Because in the long run, it'll do it again. In the long run, what I mean by do it again is it'll have another period where it has little or no return for 10 years. Little or no return for 10 years. And a lot of the people who sell those types of products that recommend those types of products, they'll point to the 100-year average. And I'm like, yeah, what's your life expectancy? How long do you expect to live, in other words? Could you afford to retire in March of 2000 when the S&P 500 was actually at 1,500? Right now, here you are 17 years later. In fact, I'm going to look at the SPDR. That's a fund, one of the bigger funds in the universe, by the way. Lots of people are doing this. So you invested in it. It's $150. 17 years ago. 17 years ago, it's $150. It's $235 today. So that's like a $15 stock going to 23. Sound exciting? 15 going to 23, and it takes 17 years? Are you kidding me? You'll be back to work. You retire with that kind of return, you're going to have to find a job in your 70s. That's what's going to happen. So how do you avoid that? Well, you try to do a couple things like don't buy stocks if they're selling for more than they should be. How do you avoid that? Well, you've got to know your strategies very well. I would avoid the S&P 500 right now in particular. There are other indexes that you can invest in. There are fundamentally weighted indexes. In fact, I run a few of them that I created myself, and I'm going to show you them. And we're going to talk in detail about the newest model I created that I'm pretty sure Ben Graham would look at that and go, hey, that's a good idea. And incidentally, a lot of these ideas anybody could do. Anybody could do. And I never hold back. I'll show you exactly what I'm doing. I don't hide anything. I tell you exactly what I'm doing. Again, that workshop, it's free. It's at Tri-Cities Corporate College, which, by the way, is awesome. The facility there is great. It's the Corporate College East. Go to my website. You can sign up for it. There's a map there that even shows you where it is. The no cost to attend, and the college does a really good job with the refreshments and whatnot. In fact, I was just out there this past week to try to help them, and it'd be interesting to see if they use the material that they shot this little video. I think it's going on their website. But anyway, if you have a phone call, question, or comment, I always forget to bring that number out right off the bat. I should do that. Should tattoo that backwards on my forehead so I read it in the mirror right before when I get up in the morning. Anyway, the number here is 216-901-0945, 216-901-0945, and I've got Gary. Gary, you got a question for me?
Yeah, good morning, Bill.
Hey.
What would you recommend for someone who's got a lot of cash on the sidelines right now? What would you recommend they do at this point in time, given the lofty market valuations?
Well, the market's lofty valuations are only in a few stocks. They happen to take up a lot of weight. They happen to be counted heavier in the market cap weighted indexes like the Russell 1000, S&P 500, that sort of thing. Across the board, valuations are pretty good. I mean, some of them are really good. So I would stay away from the market cap weighted indexing for now, particularly now. And I would try to go out with some more fundamentally oriented things. There are lots of fundamentally oriented products that you can take a look at that I think are going to do fine over the next 5 years or so. And this is typically what happens when an administration comes in, cuts taxes, and increases spending. You get a really good bump in the economy. That's actually one of the reasons the economy, stock market's going. Stock market tends to go up before the economy actually shows that improvement. So if you're waiting for the economy to get going, you're going to miss the move in the market. So I would take a look at multiple items. There are fundamentally weighted indexes out there. That's what I would look for. If you're doing a search online to do this yourself, by yourself, that's what I would do. Personally, I've got a couple models. One of my models, the one we're going to be talking about at the seminar, looks at the cash a company's generating, basically the operating income. And it's not earnings before interest, tax, depreciation, amortization. That's another whole animal. Basically, I'm looking at how much raw cash the company's generating before they make adjustments for depreciation and amortization. And I'm measuring the cost of the entire business compared to how much cash it's generating. So, Gary, it's kind of like if you're going to go buy a house and you looked in a neighborhood and there was a house for sale and it's 2,000, let's say it's 2,500 square feet and it's for sale for $250,000. So if it's 2,500 square feet and it's selling for $250,000, what's the price per square foot on that? It's $100.
$100 a square foot.
Yeah. So if you saw that all the other houses were selling for $125 to $130 a square foot in that neighborhood, would you be more interested in it or less interested?
Yeah, more interested.
Yeah, more interested, absolutely. So what I'm doing is the same thing I'm doing with that house. I'm looking at all stocks. I'm saying, all right, let's take the cash flow, divide it by the true cost of owning the business, which is the enterprise value. That's the stock plus the debt, because the owner has to buy the debt, by the way. It has to pay the debt off. And you subtract out the cash from that because you get the cash back. If if you buy the company, they have to turn everything over to you. So you look at the enterprise value. You can divide the cash flow by the operating income by the enterprise value, and you can get a yield. And you can now compare one stock against another. How cool is that? So you can see where the bargains are, and that's where you go. That's what I'm doing. And
but isn't a lot of the stock prices they're not really rational? They determine.
Oh, that's why we're doing this, because let's say I do an operating income, and I say that this company A is selling for $1 billion. They have no debt. They made $100 million in operating income. 100 million is 10% of $1 billion, right? It's 10%. Right. So then I look at company B. It has $1 billion stock market value. It has $100 million in operating income, which is 10%, but they have $1 billion in debt. Okay. So if you buy that company, you're going to have to pay the debt off. You're actually paying $2 billion, even though the stock value, which is the only thing that gets reported in the Wall Street Journal, by the way, the stock value is only $1 billion on paper. If you're just looking at the stock market, it looks like it's just as good a deal as company A, but it's not. Because when you buy company B and you have to pay the $1 billion off, in addition to the $1 billion you paid for the stock, the yield that you got, the $100 million you got, is only 5%. You see what I'm saying?
Sure.
So that's what I'm doing. I'm just taking the top 1,500 companies in the country, and I want the top 50. I want the 50 with the highest cash yields right now. I want the best. I want to find those $100 per square foot homes in a neighborhood of $125 square foot homes. Does that make sense?
Yeah, it does, Bill. Thank you very much.
Yeah. Well, thanks for calling. And that's kind of what we're going to be looking at the seminar. How do you do that? How do you find that information? How do you put together baskets of portfolios like that? Because you can actually do this as an individual. And one of the things you'll find out is a lot like work, especially if you're not spending an awful lot of money like I do on the software. But I'm going to show you how we do that, how you can do that. Another really popular model, one I like a lot. I call it the Bullington Capital High Dividend Model. It's a great model. I line up all the 500 biggest companies in the country, divide them up into the major sectors and make them up. Take the top 4 dividend payers out of each one of them. It's very similar to the other model, except that you're looking at the dividend yield instead of the operating income. So you're looking at how much in dividends they're paying. Been very popular. It's done very well. it's not as good of a bargain right now. It's still a good bargain, particularly if you compare it to the stock market in general. I think these stocks are still more undervalued than the average stock is. But I like the other model right now better. Why? Because a lot of the stocks in that other model are actually, they have cash yields that are much higher than the companies that are paying out dividends. So if you were the owner of the company, that would matter to you. If you're the owner of the company, the dividend doesn't matter. You're going to get that anyway. That's yours. That's your money that you're paying out to yourself, by the way. If you're the owner of the company, you own a C Corp, you pay a dividend, that you're paying yourself your money. So if you're the owner of the company and you're generating more cash, even if the company's not paying a dividend, in company A than company B, which one do you want? Let's say company A earned $100 million past 12 months. Or let's say it earned, $100 million. They pay no dividend. If you're the owner, you still get the $100 million. If company B earned $100 million and paid out $50 million in a dividend, so what? You still only have $100 million. That's what I'm saying. The dividend yield can kind of throw people off a little bit. It's a good model. It's an excellent model. But I think the other one brings another layer in and gives you some more diversification. That's really what you're getting. Diversification. And I'm going to show you how we do that at Bullington Capital. I'll update you on the lookout for the bull. That is getting closer. I hate saying that because, I can't believe the legalities, the stuff that it's a lot harder on small businesses, by the way. That's gotten more difficult each year over the past 10 years. Running a small business is not easy. It's nowhere near as simple as it was when I started. And I think, had it been as difficult as it is today, I'm not sure. I'm not sure I'd gone out and done this. Too late now. And there's no turning back. So I'm going nowhere. Not as hard as I fought to get here. So, and it's a good, that's a good thing. I really like it. Looking at it like a business owner, looking at the stock market like a business owner, it's kind of fascinating. That's what Ben Graham was really fond of doing. Looking at all the companies that he invested in as if he were the business owner, as if he owned the whole company, because he made a good point in the book that owning a single share makes you a part owner. That's what the stock market's all about. It's ownership, as far as he's concerned. We'll talk a little bit more about that. By the way, the last section of today, we'll talk about the other side of the trading side. He didn't like that side too much. I like it a little bit. But anyway, we're listening to Bill Bullington right here on 1420 The Answer. Stay tuned because we will be right back. And we're back. Hey, if you'd like to call and ask a question, 216-901-0945, 216-901-0945. I get asked all the time, do you think this is a good time to be in the market? And, there's never really a method that works really well to tell you when the exact right time to invest in is. And I think it's whenever you have money and there are stocks available that aren't overpriced. That's the best time to invest. And if I run these models that I'm talking about and I can't find anything, well, you're probably better off staying behind. And here's what you can do, because that never satisfies anybody. They still go out there. And what I think if when somebody says, no, there's got to be a better way, you have to know, you're just holding out on me, Bill. I know you are. You know how many times I've heard that? And people that don't say that, they look at me and I know they're thinking that. I'm just holding out on them. I know when there's perfect time to get in the market, and I'm just not going to tell you. Well, that's actually not true. The best way is, as far as I'm concerned, is if you're really concerned about getting in the market at the wrong time, this is what you do. Figure out what your decline tolerance is. That's how much you're willing to see the account fluctuate by. Multiply that by 2, and that's what you put into the market. Okay? Figure out what your decline tolerance is, what your level of fluctuation in the account that you're willing to put up with. Multiply that by 2, and then put that in the market. The rest of the money, keep in short-term fixed income. SHY is short-term treasuries. There's some other ones. I've been working on doing some research here lately that I think we might have some options that pay a little bit more than the treasuries do. Not a whole lot. The yields are like 1.2, 1.34. I think one of them's close to 1.75, but which is a lot more than local CDs are. But it's not a lot of money. Anyway, just got buzzed on my phone. This is hilarious. My phone now goes to my watch, which vibrates on my wrist and tells me I got a flight that's leaving this afternoon. How wild is that? Anyway, so there's some, this back to what we were talking about. Is this a good time to invest in stocks? Well, there's never a super bad time. If you see that the market's crashing, here's what you want to do. You go in, you figure out what your fluctuation level is, what kind of fluctuation you're going to be willing to put up with. You multiply that by 2. That's what you start with. So let's say I only want to be down 15%. Incidentally, somebody who has a 15% tolerance for fluctuation probably not going to make much money in today's stock market environment, in today's investment environment, not the stock market environment, but the investment environment. We'll come back to that a little bit later. That's an important fact, though. But let's say 15% is the number. Okay. Multiply 15 by 2. What do you get? 30. 30%. That's what you put into the stock market. Why only 30%? Because if the market goes down like it did in 2007 through 2009, 2008 and 2009, was down by half, okay, and your stocks are there, the chances of your stocks not going down by half are about as good as the Browns going undefeated next year. There's a chance. It's just not a good one. There's a chance that you'll be the lone investor whose stocks don't drop like a rock when the entire market drops by 50%. Okay, so if you were 30% invested and the market's down 50%, you're only down about 15% or so. See what I'm saying? Now, here's the more important part. If you got a big drop like that, you've got all that money sitting there in short-term fixed income, which if it's gone down, it hasn't gone down much. Gives you the ability to move some of that money over into those stocks when they're on sale. How cool is that? And this is why this works. That's one of the reasons it works. Here's another reason that this works. Let's say you did that. You put 30% in. Then it goes way up. Market has a great run. The stocks in general up around 30%. Now, if you're doing a lot of value stuff, you're probably going to lag that. But you got a mix of value and momentum. Probably going to be somewhere in the neighborhood. So let's say you're up 30%. 30%. If you had 30% of your money in there the year before, and it's up 30%, well, now your portfolio is actually roughly 39% stock, and the rest of it at 71%. Is that 71% or 61? It's 61. 61% of it would be in fixed income. You started off at 70-30. But now, because the stocks have gone up so much, you actually have more money in stock. So if your goal is to work your way towards a 60-40 blend, guess what? The market's helped you out along those lines. And then if it goes down, you have the ability to move some of that money from the fixed income, short-term bonds, government bond funds, over into the stocks. And you can take advantage of the lower prices. So this way, you do not have to know whether now is the right time to invest because you know what you're going to do in either case. You don't have to know. You take that pressure off yourself and off of your advisors. I can't tell you how many advisors will buckle and tell you what you want to hear to get your money. They'll buckle. And a lot of them are very well intentioned. But an awful lot of clients come in and they say, no, I know you can do this. You just have to try really hard. You can make sure we're not going to lose a whole lot of money if the market goes down, or at least my account value is not going to drop by very much if the account goes down. You keep saying that to people, somebody's going to tell you what you want to hear, take your money, and then it's going to happen anyway. Okay. And then you know what they're going to say? Well, look at everybody else. So that's one of the reasons at my firm, Bullington Capital, we don't take just everybody. I don't take just everybody that comes in. And incidentally, I have clients who sit through these conversations that we have. We look at how markets have responded. We look at how the models I run have responded. And we come up with a plan, and then they go home, and then they send back a questionnaire that has half the fluctuation that they thought that they were going to take when they left the office, because they get home and they start, watching the news. And that's okay. But the idea is that you got to give some thought to how much fluctuation you're willing to put up with. And today, and this is why we're doing the seminar and the Ben Graham thing, I think it's more appropriate right now. Why? Because there are a lot of stocks. Like, you take the biggest 50 companies just by size that make up the stock market, and there are no bargains there. There are none. The biggest 50 companies that make up the S&P 500, what a lot of people refer to as the stock market, it's not, but that's what they refer to it as, are overpriced. And they make up a fairly big chunk of the S&P 500, that thing that people refer to as the stock market. So if you haven't been investing in those and you've been keeping up with it, you've been doing a really good job. If you have been investing in those, you've been enjoying the returns, and I'm here to tell you, you're probably going to be going sideways for quite a while. It's not going to, it could crash, but is it likely to crash? I don't think so. I don't think so, because you've got GDP growth now back above 3%. Interest rates are still low. Nobody's talking about raising them up seriously, not by a lot. At some point in time, maybe that's going to happen. Yeah, I think it's actually, there's a better chance of it happening sooner now rather than later. I've been saying for years that interest rates aren't going to go up anytime soon. Well, if you look back to when I first started saying that, right around 2008, 2009, when I said, look, they're probably not going to go anywhere for until at least 2013, which was 5 years. And everybody went, oh my God, that'll never happen. What year is it? It's 2017. And they're actually lower than they were when I made that statement. And that's not, I'm not really, any first year econ student could figure that out, by the way. That is not an observation that's a great thing. It's not hard to do. They don't teach those classes in high school. Actually, you go to money, credit, and banking. That's kind of, back when I was in school decades ago, it was like the third class an econ major would take, money, credit, and banking. Anybody that ever took that class and paid attention would realize what was going on, and that rates were probably not going up anytime real soon. The economy was in really bad shape. It just had a major crash. To raise interest rates in that environment, and to know that the average business cycle is minimally 36 months. So that was not a bold statement to make. Okay, and now I'm telling you that are they going to raise interest rates? Probably not, but I wouldn't put it past them. And especially from what I've seen going on in the past couple of years, I wouldn't put it past them. So they may just raise interest rates despite the fact that it would have a very negative impact on the economy. That's exactly the thing that you want to see happen if you're running for office, right? Economy goes right back into recession, and guess who gets blamed? Yeah, that's right, the government. At some point in time, will it happen? Probably. Is it going to be soon? I don't think it's going to be really soon, but it could. It's a lot more likely to happen now than it was a couple of years ago. But that's like saying, the Browns are probably going to do a whole lot better next year than they did this past year. And who knows, they might, probably not going undefeated. Probably, I wouldn't bet on them making the playoffs, but they could do a lot better, because you know what? You're not really comparing them to a really rough, track record to match. Not hard to match last year. Yeah, any improvements, pretty good. So, I feel bad for those guys too. That's another whole story. But I probably shouldn't compare this too much to competitive sports. But they do have, there are a lot of similarities. And the economy is going to do whatever it's going to do. I think it's going to do well. If you want to pick yourself up, if you want to feel better, go to Bloom Energy. This was a company that was going to come public, and then they decided they didn't need the money anymore. They make more money staying private than they will going public, and that's kind of another whole issue we'll have to talk about it on another show down the road. But look at Bloom Energy. Look at what they're doing. Go to Toyota's website and look at the amount of information on their fuel cell car. Go and spend time with that. Okay, don't be lazy on this. This will make you feel better. The innovation that's coming out of the auto industry is really rapid. It's creating jobs. It's creating sales. It's creating highly profitable products. Now, electronics are extremely profitable. Ask Dell Computer. Ask Apple. Ask Intel. How much money you guys make? They make a ton. This is all coming through the auto industry. Big deal. Spend a little bit of time doing Googling hogs, the word hogs, H-O-G-S, and pipelines. Just Google that. Watch what you come up with. They got robots running inside the pipelines. The technology is wild, and it's not just a few. They're everywhere. Pipelines have become extremely high-tech, so which I find is also interesting. Take a look at Boeing. Look at how much more mileage they're getting out of the engines on those planes. If you dig into it deep enough, you'll find out how much longer they're lasting. Look at do some natural gas studies. Find out in Qatar. I forgot what the national airline of Qatar is. There's a big airline that's out of Qatar that runs on jet fuel that's made from natural gas. Okay, so when you're hearing all this negative stuff, it helps to start looking at some of the positive stuff, because there are a ton of positives. And by the way, the only thing that's holding up the positive developments, it's politics. That's what's holding it up. So there have been a lot of things that were freeing up. Even before the election, things were starting to move. And, Trump is he's pro-business. He's a pro-business president. You may not like him, or you might love him. I don't know. I can tell you this. He likes businesses. And we had Jeff Brooks from Apple Growth Partners, an accounting firm, regional accounting firm. You got a small business, you need help? Look him up. Apple Growth. We had him in talking about the cuts to taxes. I got to tell you, this is another thing that's not a really big prediction. It's not a big deal to say this. When you cut taxes and increase spending, GDP growth tends to increase. That's like saying, the Cavs should probably win at least half their games. They've spent a lot of money. They got a lot of superstars. As long as they stay healthy, probably going to win at least half of their games. And it's the same thing with the economy right now. You spend money, you cut taxes, especially corporate taxes, and guess what? You get a short-term bump. Now, whether or not that leads to another overpriced market and another crash one day, that remains to be seen. You can get a good 4 or 5 year run out of something like what they're trying to do right now. And if they do it responsibly, then we're going to get benefits that go for a decade or longer, maybe 20 years. Yeah, if they do it irresponsibly, you get 5 good years and a crash. So let's hope for the second one, but I'll take the first one because we're kind of defensive anyway. And I've got to take a phone call right now. If you'd like to call in, 216-901-0945. And actually, I think, hey, Jerry, are you there?
Hey, Bill.
Hey, you know what? I've only got about 60 seconds, and then I got to go to break. Actually, it's less than that now. So what I'm going to do is I'll just put you back on hold if that's okay. I just wanted to tell you.
That's fine.
All
Absolutely.
Right. Okay, thanks.
Sure.
Okay, so and if you'd like to call, we are going to take a real quick commercial break here in a few seconds. This is Bill Bullington. I'm here every Saturday morning from 11 to noon, 1420, The Answer. You can also find me on iTunes, the Bullington Capital Report, and Salem, the company that owns this station, has a podcast. They capture this show now and put it up as a podcast. So if you wanted to download it, want to go back and listen to it, feel free. Also, feel free to sign up for our seminars at my website, bullingtoncapital.com, and I will be back after these commercial messages. And we're back. Hey, Jerry, you still there?
Yes, sir. Hey, hi, Bill. I was wondering, we've got a couple questions. One, do you still like this Applied Optoelectronics, AAOI, as a momentum stock?
Yeah, it came up again, actually. And I got stopped out of that a couple times. And yeah, but I still like it. And valuation on it is getting a little bit high. It's not super high, though. It's less than 3 times annual revenues, and these companies have a tendency to get up to 6 or 7 near their peaks. That's just historically, anyway, they've gotten that high.
So it's still got some run to it, then.
Yeah, I think so.
I do too. I've been following. I've done a little trading, and it seems like a nice stock. How does one determine when a stock loses its momentum, or when it no longer? Because I know it's a loose term, but how does one determine when it no longer looks to be a momentum stock? How do you figure that?
Everybody has their own definitions, and unfortunately, you'll have to come up with one that you're comfortable with for yourself. So I will generally take a look, and if it's closed lower than the lowest close it's had in the past 3 weeks, I'm out.
Closed lower than the lowest close in the past 3 weeks. Okay.
Now I can also tell you that in certain market environments, okay, that you could just use a 15% trailing stop and you'd be fine.
Okay.
And we're in that type of environment right now. That's where the 15% trailing stop. And if you remind me, I don't know if you're coming to the next seminar. If you remind me, I'll bring that up. I'll show you what I'm talking about there.
Those are 2 good indicators. I said, does volume have much to do? I assume volume has quite a bit too.
Not really, because you know what happens. This has been going on more and more over the past few years. A big hedge fund wants to get a position in a stock. They will start by shorting the stock and punishing it, putting it down significantly. Yeah. Oh, yeah. So you'll see the stock spike down on huge volume, and then you'll see it rip right back up again. Those guys were basically, they're manipulating share prices legally, by the way. That's not illegal to do. And and it aggravates the dog out of me when it stops me out of one of my stocks.
But it kind of sounds like fishing. You're waiting to set the hook.
Absolutely. But you can't. Unfortunately, there's no way of telling whether somebody's just trying to get a better price or if they're selling for real. So I will err to the conservative side. I generally it'll hit my stop. I'll get stopped back out, and then I end up having to buy it back at a higher price. So.
Okay, so you're saying a 15%
trailing stop, yeah. And now I wouldn't do that on or the low of the last 3 weeks. If it closes below the low of the last 3 weeks.
Low of the last 3 weeks. Okay. The other thing I'm interested in is establishing a screen for momentum stocks that are, say, in the top 500 of the no, not even that. Maybe Dow Jones or top 500.
I wouldn't. I wouldn't do the Dow Jones because those are big old stocks. They don't move like the mid and small cap stocks do, and you're gonna need you're gonna want to stick with the companies that are moving really fast. Now, I will say that stocks like Apple and Google, they're in the technology field. You can actually trade those much more successfully than you're going to be able to trade GE or IBM or Ford or GM.
Sure.
Those stocks are horrible trading stocks. They're horrible.
Okay.
You'll get, if you make any money at all, it's going to be minimal. So I would stay away. I would take a look at it instead, and this is one that's killing me, by the way. I was talking to the people in my office about not having attachment when you're trading. Stocks don't know you own them. The people that are out there don't know you own the stocks. The big, 1,000. So you can't take any of this personal. All you can do is
course.
You just have to respond. And both the good and the bad. And I was just lamenting. Sierra Wireless comes up. It's got a classic breakout pattern at $17.10. Okay, well, that was about a month ago. It closed Friday at $27.80. Wow. And less than a month, a couple weeks ago, and in one day it had closed at $24. The next day it closes at a, hang on a second. I take it back. One day it closed at 1850. The next day it closes at 24.50. Or $25. Yeah, it had gapped up. Now I did catch Pier 1 like that a few weeks ago, and it was up 32% in a day. But and my point here is that you can't let that bother you. It still bothers you, by the way.
Oh, of course it does. Of course it does.
But you got to stop. You have to try to minimize the damage. Now I laugh about it now, but I'm going, oh, I was fully invested, and I saw that company. I had traded that stock back in the late 90s. They make communications equipment. And here's what's happening, by the way, the semiconductors and the communications equipment in wireless, they're moving to 5G. Europe already has it. 5G does a tremendous number of things that 4G does not. It's not just for cell phones. So the equipment that's made for that, there's a ton of equipment, and they're going to be replacing all that other equipment now. The 3G, the 4G, that's all going away. It's going to be replaced by this new 5G, which not only is going to increase your internet speeds on your cell phones. Most people have smartphones today, and a lot of people are just using them instead of computers, which is really kind of wild. But they need really fast internet connections on their cell phones. So that's going to speed that process up a lot. But it's also going to allow your cars to talk to each other. So these cars that are self-driving, they can detect.
Right.
Yeah, they can detect the car in front of them using 5G technology. At least that's my basic understanding. And I am not an electrical engineer. All I know is what I read. So if you are an electrical engineer and I'm wrong, shoot me an email. I'd love to know about that. But from what I've read, there are a lot of things that they're going to be using that for, in addition to the cell phone, which the cell phone carriers are going to be selling as add-on services. They're not going to even market those to the general public. That would be like the fleet managers and that kind of thing, and insurance companies. There's a huge amount of potential in that realm, and that's one of the reasons that those stocks are running like crazy, because they're making that equipment. That's not something you can do over the existing equipment. You have to upgrade all the facility, and a lot of the devices have to have the later semiconductors in them. And your cars.
Hey, Bill, I was going to ask you one last thing on the 15% trailing stop. Now that, when you say that, you have to move the trailing stop.
You do not. You don't. Actually, your broker will do that for you. And I have I have to be careful that the brokerage firms don't like me mentioning their names anymore, because they're afraid I might say something that might get them in trouble. But there are a couple that I like a lot, that do as much as they can to try to prevent you from being taken advantage of by some of the flash boys. These guys will flash orders out there and trip your stops, even though they've never traded anything at that price. They're basically just robbing you. To try to avoid that or minimize that, there are a couple of brokers out there. If you want to call me in the office, I'll tell you who they are. But they try to minimize that, because that is a real threat. You've got robots trolling the financial markets, trying to trip stop orders so that they can basically take your money. And
are you okay? I was going to say, are you saying that like a trailing stop has to be done through the brokerage, or
yeah?
No?
Well, if you're going to do it by hand, you're going to have to sit there in front of your screen and watch it all day, every day. Yeah, so
of course, you don't want to do that.
Yeah, so when you order these, you enter these orders. Actually, both of the firms I use allow or require that the company has had at least 200 shares trade at a specific price before it will trigger one of your stop orders. That prevents a unscrupulous market participant from coming in and flashing up an order that's below the current price to see if they can trigger stop orders so that they can then jump in front of them and take advantage of them. So that's what I would be, and that risk is always there. And in a flash crash, you're probably going to get hit anyway. A flash crash, you'll be down a lot on your trading account. That's one of the reasons that I'm telling people not to put more than 25% of your investable assets in something like that. Because that thing can be down 10 or 15% in an hour now.
Wow.
It's a lot riskier than it used to be. The good news is stocks move up way faster than they have even during the late 90s. It's pretty wild. It's amazing how the time periods have condensed. Where back in late 90s, it would still take a stock 6, 8, 9, 10 months to go up a lot. It'll do that now in 6 weeks to 6 months, and then turn around, give it all back, and then start another run again.
Jeez.
So
Hey,
yeah.
Bill, I was going to say Sierra Wireless was the one company that you said I may want to go back and look at that, not to trade
Yeah,
it, but just watch the patterns. That's pretty wild.
Well, the price to sales ratio on it is really low, so it's from a valuation standpoint, it's a good one. The symbol on that one is SWIR. By the way, I don't own that one yet. It's on my radar. I probably will be picking that up, so I have to let everybody know about that. But
there you go. All right. Well, have a great weekend, Bill.
Hey, thanks. You too. Thanks for calling. And you've been listening to Bill Bullington here every Saturday morning from 11 noon. What I was just talking about, by the way, the last section of the show, I normally talk about trading. One of the few people that does what I do that actually trades and has done pretty well with it. So pretty well is a definition. Anyway, we'll talk about that a little bit at the next seminar too. But for the vast majority of people, I think there are lots of good values out there. You just got to know how to find them. I think the next 3, 4, 5 years probably going to be pretty good for the stock market in general. Not that it won't be without bumps, because it will. And if you come to the workshop, we'll actually just go to bullingtoncapital.com to learn more about it. Now that I hear the music, that means the show is over. Thanks for listening, everybody. Again, my name is Bill Bullington here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.